What if the home you bought as a safe investment is quietly losing value, and nobody around you is talking about it? Not in a dramatic, headline-grabbing way, not in a way that shows up in your neighbor's conversation or your local news, but slowly, steadily in the data. In the number of days homes are sitting unsold, in the number of sellers who started high and ended up cutting their price twice, in the number of buyers who are no longer in a hurry. That is the story happening right now across specific U.S. real estate markets, and most people are missing it because it does not look like a crash from the outside. The neighborhoods still look nice, the school ratings are still strong, the zip codes still sound desirable, but the market is moving differently. And once you understand how to read that movement, you start seeing things that most buyers and sellers are still ignoring. This is exactly what we are going to break down today. 10 U.S. real estate markets where the numbers are already telling a very different story than the surface. Whether you own a home in one of these areas, are thinking about buying, or are simply trying to understand where the housing market is actually headed, this is the kind of breakdown you need to see before making your next move. Let's get into it. Before we go city by city, let us talk about how housing markets actually weaken, because most people have the wrong mental model. Most people imagine a real estate crash as a sudden dramatic event. Prices fall off a cliff, headlines scream, the news runs specials, but that is almost never how it starts. What actually happens is quieter and in some ways more dangerous because it sneaks up on sellers who are still operating on last year's confidence. It starts with time. Homes that used to sell in 2 or 3 weeks start sitting for 60, 90, 120 days. Then sellers start making small price cuts, not big enough to alarm anyone, but enough to signal softness. Then buyers start noticing the cuts, and once buyers figure out that they no longer need to rush, the entire dynamic of negotiation shifts. The buyer gains power, the seller loses it. And in a market full of comparable homes, similar square footage, similar school zones, similar price points, that shift moves fast because every new price cut becomes the next seller's problem. The 10 markets we are covering today are all showing early to mid versions of that pattern right now. Some are further along, some are just beginning, but all of them are flashing warning signs that deserve serious attention if you have money on the line. Here is something else worth understanding before we dive in. The markets most at risk right now share a few common traits. They grew fast during the pandemic boom, often driven by remote work migration or speculative buying. They have large amounts of similar housing stock, new construction, master-planned communities, cookie-cutter subdivisions, which means sellers directly compete against each other on price, and they are in the middle to upper middle price range, which means buyers are stretching their budgets and are among the most sensitive to rising mortgage rates and economic uncertainty. Keep those factors in mind as we go through each market. You will start seeing the pattern repeat itself. Number 10. Boise, Idaho. A few years ago, Boise was one of the hottest real estate stories in America. Remote workers flooded in from California and the Pacific Northwest. Prices surged. Bidding wars became normal. Local buyers were getting outcompeted by cash offers from out-of-state transplants. It felt unstoppable. Today, Boise is one of the clearest examples of what happens after the boom. Home prices in the Boise metro have corrected significantly from their pandemic peak, and the market is still working through excess inventory that built up as the migration wave slowed. Days on market have extended considerably, and price reductions are now common across nearly every zip code in the area. What makes Boise particularly telling is the seller psychology. Many owners here bought at or near the peak and are still mentally anchored to those prices. They are listing at levels the market no longer supports. And so homes sit. Every week a home sits, it loses a little more of the urgency that once made buyers compete. That is the cycle that once it starts, is very hard to reverse without meaningful price movement. For anyone considering Boise right now, as a buyer, this may actually be closer to an opportunity than a warning. But for anyone who bought in 2021 or 2022 and needs to sell soon, the math has gotten significantly harder. Number 9, Austin, Texas suburbs. Austin proper gets a lot of attention, but the real pressure in the Austin metro right now is happening in the outer ring suburbs, places like Pflugerville, Kyle, Buda, and Hutto that grew explosively during the pandemic as buyers got priced out of the core city. These suburbs promised value, more square footage for the dollar, newer construction, master-planned communities with amenities. And for a while, the formula worked perfectly. But in 2025, the formula is under real stress. The outer Austin suburbs are dealing with a very specific problem. They have too much of the same thing. Builder-grade homes, same floor plans, same lot sizes, same community amenities. In a hot market, that uniformity creates momentum. Buyers just want access to the growth story. In a cooling market, it creates brutal competition. When one builder offers $50,000 in incentives, every resale seller in the same zip code has to respond. When one home cuts its price, the next listing immediately looks overpriced by comparison. Days on market in several of these outer suburbs have pushed past 90 and in some cases past 100 days. Year-over-year price declines are now visible in the data. The growth story that once made these areas feel like smart, early moves is now requiring buyers to ask much harder questions about whether the price still makes sense. Number 8. Cape Coral and Fort Myers, Florida. The Southwest Florida market had one of the most dramatic runs of any housing market in the country, and it is now experiencing one of the more significant corrections. Cape Coral in particular, a city famous for its canal-front lifestyle and its affordability relative to Miami or Naples, saw price gains that went far beyond what local incomes and local demand could sustainably support. The correction here has been driven by a combination of factors that stack on top of each other in a way that is particularly painful for sellers. Insurance costs in Florida have surged dramatically, property taxes have risen, HOA fees in many communities have increased, and interest rates have made monthly carrying costs far higher than they were when many of these homes were originally priced. What that means in practice is that a home priced at $400,000 may carry monthly costs, mortgage, insurance, taxes, HOA, that feel significantly more expensive than that same sticker price would have suggested 2 or 3 years ago. Buyers are doing that math now, and many of them are walking away from deals that do not pencil out. For sellers in Cape Coral and Fort Myers, the challenge is that they are not just competing against each other. They are competing against the growing perception that buying in coastal Florida right now carries more risk, financial, environmental, and logistical, than it did during the pandemic boom. That perception is shifting buyer behavior in ways that take time to show up in price, but they are already showing up in volume and in days on market. Number 7. Sacramento, California. Sacramento was one of the clearest beneficiaries of the Bay Area exodus. When remote work made it possible for tech workers to trade San Francisco or San Jose for a city with a much lower cost of living, Sacramento absorbed a significant wave of that migration. Prices rose fast, and the local market went from sleepy to competitive almost overnight. But the remote work wave has stabilized. Many companies have pulled workers back into offices, and Sacramento is now left with pricing that got pulled up by Bay Area buyers, but has to be sustained by Sacramento-level incomes and Sacramento-level demand. That gap is real, and it is widening. The markets in and around Sacramento, areas like Elk Grove, Roseville, Folsom, and Rancho Cordova, are all showing extended days on market and year-over-year price softness. Sellers who bought in 2020 or 2021 still have significant equity and can afford to be patient, but sellers who bought in 2022 or early 2023 are in a more difficult spot. They may have purchased near the top of the migration-fueled boom and are now trying to sell into a market that no longer has that same fuel source. For Sacramento, the story is not one of collapse. It is one of recalibration. But recalibration is expensive for anyone on the wrong side of the timing. Number 6. Phoenix, Arizona. Phoenix has gone through dramatic real estate cycles before, and it is doing it again. The metro saw explosive growth during the pandemic, a combination of domestic migration, investor buying, and speculative new construction that pushed prices to levels that surprised even longtime local observers. The correction in Phoenix has been uneven but significant. Investor activity, which at its peak accounted for a striking share of home purchases in some zip codes, has pulled back sharply as rental income projections have not kept pace with the prices paid during the boom. When investors step back, they leave behind a gap in demand that is hard for regular buyer pools to fill immediately. New construction is also a complicating factor. Phoenix has significant new inventory coming to market, and builders are competing aggressively, offering mortgage rate buydowns, upgrades, and cash incentives that resale sellers simply cannot match. A buyer today can choose between a brand new home with a subsidized mortgage rate or a resale home at a similar price with no incentives. That is a genuinely difficult value proposition for resale sellers to win. The result is a market where prices have softened, days on market have extended, and seller confidence, which was stratospheric just 2 years ago, is now running into the reality of what buyers will and will not pay. Number 5, Nashville, Tennessee suburbs. Nashville has had one of the strongest real estate reputations of any mid-sized American city over the past decade. No state income tax, a growing job market, a cultural identity that attracts both young professionals and families, and enough momentum to make buyers feel like they were always one step behind. But Nashville's suburbs, areas like Murfreesboro, Smyrna, Spring Hill, and Mount Juliet, are starting to show meaningful signs of stress. These communities absorbed a massive amount of new construction during the pandemic years as builders rushed to meet the demand from people relocating to the region from higher-cost cities. That new construction is now the problem. There is simply a lot of it, and it is all competing for the same buyer pool. Master plan subdivisions with hundreds or thousands of similar homes create an environment where pricing pressure is almost mechanical. When one home cuts, it sets a new benchmark for the whole neighborhood. And when builders are still selling new inventory nearby with attractive incentives, resale sellers are fighting an uphill battle they did not anticipate when they bought. The broader Nashville area still has fundamental appeal. Jobs, quality of life, population growth, but appeal does not automatically translate to price support when supply is running ahead of demand. And in the outer suburbs, that supply-demand equation has clearly shifted. Number 4, Denver, Colorado suburbs. Denver was one of the strongest housing markets in the country throughout the 2010s, and it retained that reputation well into the pandemic era. The combination of outdoor lifestyle appeal, a strong tech and energy job market, and relatively lower prices than West Coast cities kept demand strong for years. But the suburbs that grew fastest around Denver, communities in Douglas County, along the I-25 corridor, and in the newer developments north of the city, are now experiencing the kind of slowdown that tends to follow rapid demand-fueled growth. The issue in Denver's suburbs is layered. Colorado has seen significant increases in property insurance costs. The state's home prices moved into a range that puts serious strain on middle-income buyers, especially with mortgage rates at current levels. And the job growth that once felt endless has moderated, particularly in the tech sector, which drove a disproportionate share of demand. What you are seeing in the data is extended days on market, growing price reductions, and a buyer population that has largely lost the sense of urgency that once defined competition in these zip codes. Sellers who needed that urgency to justify their pricing are now having to make harder decisions about whether to wait, reduce, or pull their home from the market entirely. Number 3, Las Vegas, Nevada. Las Vegas is one of those markets that makes a lot of sense when momentum is strong and becomes very complicated when it slows. The city's real estate market has always been heavily influenced by investor activity, speculative buying, and migration patterns, all of which are more volatile than the organic income-driven demand that supports more stable markets. During the pandemic, Las Vegas benefited from a wave of buyers leaving California, Nevada's lack of state income tax, and a broader surge in demand for more space and more affordability. Prices moved up fast, and inventory dried up quickly. Today, the picture is meaningfully different. Investor activity has pulled back, the California migration wave has moderated, and Las Vegas is left with a market where price gains from the boom era have to be sustained by a buyer pool that is more cautious, more rate sensitive, and less confident than it was 2 years ago. Days on market have extended across much of the metro. Price reductions are now a common feature of listings that once would have generated immediate offers. And in some of the newer suburban developments on the edges of the valley, the combination of high prices, high carrying costs, and softer demand is creating a difficult environment for anyone who needs to sell on a timeline. Las Vegas has recovered from real estate pressure before. The city went through a severe correction after 2008 and came back strongly. But knowing that history does not make the current transition any easier for sellers who are in the middle of it. Number 2, Raleigh-Durham, North Carolina suburbs. Raleigh-Durham spent the better part of the past decade being called one of America's most promising real estate markets. The Research Triangle's combination of universities, major employers, healthcare systems, and a relatively affordable lifestyle made it a magnet for educated workers and growing companies alike. And then the pandemic turbocharger hit. Remote workers piled in from the Northeast, tech companies expanded their footprints, population growth, which was already strong, accelerated. Home prices surged and competition became fierce in ways that longtime locals had never experienced. The outer suburban communities that grew most rapidly during that acceleration are now facing the clearest pressure. Areas that saw massive new construction in Johnston, Chatham, and Harnett counties added thousands of new homes in a very short time frame. That construction pipeline takes time to slow even after demand begins to soften, and the result is a growing supply of similar homes competing for a buyer pool that is no longer growing at the same rate that it was. Days on market in many of these outer communities have risen sharply. Sellers who listed expecting quick, competitive offers are instead watching their homes sit and struggling to understand why the energy has left the market so quickly. The answer is almost always the same. When growth stories slow, buyer urgency slows with them. And once urgency fades, prices have to do more work to generate interest. That is an uncomfortable adjustment for any market that got used to demand doing the heavy lifting. Number 1. Dallas-Fort Worth exurbs, North Texas. And this is the one that matters most, not because it is the most dramatic collapse, but because of what it reveals about how premium suburban branding can become a liability when the market turns. The outer ring of the DFW Metroplex has some of the most polished, well-marketed, well-amenitized suburban communities in America. These are places with resort-style pools, walkable town centers, top-rated schools, and HOA-managed landscaping that makes everything look perpetually ready for a magazine shoot. During the boom, all of that polish commanded serious premiums. Buyers paid not just for the square footage, but for the brand, the lifestyle, and the story, the idea that they were buying into one of America's most dynamic growth corridors. But in 2025, premium branding is not sufficient when buyer urgency is gone. And buyer urgency in the North Texas exurbs is measurably, meaningfully softer than it was during the peak. The most expensive and most branded communities, areas that built their identity around being the aspirational version of suburban Texas, are now seeing some of the sharpest year-over-year price movements in the region. And that is the signal that matters most. When the premium product in a premium suburb starts losing value fastest, it tells you that the confidence premium, the extra money buyers once paid for the feeling of being in the right place, is evaporating. That is not just a local real estate story. It is a window into what happens to aspiration-driven pricing when the buyers who once competed to access it decide to wait instead. And in 2025, across the DFW exurbs, that decision is playing out in the data in real time. The communities still look beautiful, the amenities are still real, the school ratings are still strong, but the market is no longer rewarding patience with price increases. It is rewarding patience with better deals. And once buyers figure that out, seller leverage does not come back easily. So what does all of this mean for you? If you own a home in one of these markets, this is not necessarily a reason to panic, but it is a reason to pay close attention. If you are thinking about selling in the next 1 to 3 years, the window of strongest pricing may already be narrowing. Waiting and hoping the market snaps back quickly is a strategy, but it is one worth stress testing with real data from your specific neighborhood, not just the general headlines. If you are a buyer looking at any of these markets, the environment is shifting in your favor. More inventory, more days on market, more sellers who are willing to negotiate. These all represent leverage that simply did not exist 2 or 3 years ago. Buying in a softening market with a long-term holding horizon is a very different risk calculation than buying at a peak with immediate resale in mind. And if you are just watching, trying to understand where real estate in America is actually headed, the markets we covered today are some of the clearest leading indicators available right now. They are telling you that the era of automatic appreciation, of homes selling themselves in a weekend at prices no one questioned, is over in a meaningful number of places. What is replacing it is a more traditional market, one where price, condition, timing, and negotiation all matter again. That is not a catastrophe, but it is a shift. And the people who recognize the shift early are the ones who get to act on it before everyone else does. If this breakdown was useful to you, make sure you subscribe. We cover the real numbers behind U.S. real estate markets every week. Drop your city or zip code in the comments and let us know which market you want us to analyze next. And if you know someone who is thinking about buying or selling right now, share this with them. The data is out there. It just takes someone to actually explain what it means. See you in the next one.